The last video we ended with the manufacturing overhead budget. Once again, we assigned the variable overhead costs based upon the direct labor hours we anticipate taking place each quarter. The fixed cost was going to be given to us. We determined the total manufacturing overhead cost. We divide that by the total direct labor hours in order to calculate our manufacturing overhead cost per unit, which, well, not per unit, our manufacturing overhead rate per direct labor hour, which we're going to need a little bit later to compute the cost of goods sold for each of our products. Next up would be our selling and administrative expense budget. So now these would be more of our period costs taking place outside of the manufacturing organization, but they're still operating expenses. We're going to break down this budget between our fixed sales and admin expenses and our variable sales and administrative expenses. From the variable expenses, which are based upon unit of sales, there's sales commission, and there's also going to be freight out costs. So the sales commission and the freight costs, of course, are contingent upon the number of units that's going to be sold. So once again, we're going to go back to our sales budget in order to get information required to prepare our selling and administrative expense budget as well. The fixed expenses are based upon assumed data, so we'll give you the information you need to look at the fixed expense portion of your selling and your administrative expense budget. So here we go. First, these are the budgeted sales numbers. Once again, coming from your sales budget. Our variable cost is sales commission is $3 per unit. Freight out cost, which is shipping cost, is going to be $1 per unit. So again, these variable expenses you see here are based upon the expected sales in units during each quarter of the fiscal year. The fixed expense for things like advertising, sales salaries, office salaries, etc. These costs will be given to us. Here we have our total variable expenses, total fixed expenses. You add those together to get the total selling and admin expenses each quarter. Add those all together, get total amount expected for the fiscal year. Okay. So now we've done direct materials, direct labor, we've done sales, overhead, selling and admin expenses. We can take these individual budgets, combine them into a budgeted income statement. Okay? To do the budget income statement, we must first calculate what is going to be the cost to produce one unit. What's the cost to produce one right ride? And I still don't know what a right ride is, but I know how to calculate the cost to produce one right ride. So remember that from our previous budget, first our material budget, it takes 2 pounds to make 1 unit. The material cost is going to be $4 per pound. So our material cost is going to be $8 per unit. It takes 2 hours to produce 1 unit. The hourly rate of pay is $10 per hour. So our direct labor cost is going to be $20 per unit. And we said that manufacturing overhead was assigned based upon direct labor hours. It takes 2 hours to produce 1 unit. Our overhead rate per hour was $8. So the overhead cost assigned to each unit is going to be $16. So when you add those all together, our product cost is going to be $44 per unit. We anticipate selling 15,000 units. Therefore, our cost of goods sold would equal $660,000. So in our budgeted income statement, we're showing total sales from our sales budget. minus our cost of goods sold. We just calculate it to get our gross profit. Next, we have our selling and admin expenses from that budget to get income from operations, the interest expense, which is given to you in the amount of $100 to get income before income taxes. The income taxes were estimated, and here is our net income amount. So this is showing us our expected net income for the year based upon those budgets, our sales budget, production budget, our materials budget, our labor budget, our overhead budget, and our sales and expense budget. We combine those all together. We anticipate earning net income next year in the amount of $47,900. Next up, we have what's known as a cash budget. So with the cash budget, we're looking at, okay, all of our cash inflows, cash coming in or cash receipts, all of our cash outflows or our cash disbursement. We're trying to determine at the end of each quarter, will there be a surplus of cash or a cash deficiency, meaning that we're going to be short. And if there's a deficiency, do we have any financing options, or are we able to borrow money to make sure that we can take care of all of our needs from a cash standpoint? And we probably want to make sure that we keep a certain cash balance at the end of each quarter. Okay? So this is the format of the cash budget. You begin with your beginning cash balance. You would add in all of your cash receipts to get total available cash. Subtract out all of your cash disbursement. Notice that both of these are going to be itemized, and that will show whether you have an excess of cash or if there's going to be a deficiency. If we have a deficiency, we look at our financing options to get our desired ending cash balance. Okay, so the cash receipts will show all of the different sources of revenue, whether it's from sale of products, from investments, dividends, capital stock. This section will show any cash receipts that we expect to come in throughout the fiscal year. The cash disbursement will show any cash payments being made for materials, labor costs, overhead, other expenses. And then where it says financing section, this section again shows that if we need to borrow money, how much we need to borrow money. And if we do borrow money, it will show back the actual repayment as well, along with interest to the actual lender. So you got cash receipts, cash disbursement, and your financing section of the cash budget. Okay, so the cash budget has to be done in a certain order. So first again, we look at how much cash do we expect to have at the beginning of the first quarter. What's our beginning cash balance? We'll look at our cash receipts and our cash disbursement based upon the other budgets and other information provided by the management of the company to determine again whether we're going to have excess cash or if there's going to be a deficiency in our cash account. So here's some information we need to know for our cash budget. Our beginning cash budget is $38,000. So write down that number. Our goal is to have $15,000 in our cash account at the end of each quarter. That's our goal, to have a minimum of $15,000 in our account at the end of each quarter. Now let's talk about sales. We have our sales budget. Based upon historical information, we plan to collect 6% of our sales in a quarter sales took place, and the other 40% in the following quarter. So again, we plan to collect 60% of our sales in a quarter, so, and the remaining 40% in the following quarter. Account receivable of $60,000 was due at December 31st, 2016, or expected to be collected in full in the first quarter of 2017. We have some short-term investments are expected to be sold for $2,000 in the first quarter. So these are some of the assumptions that we have for our cash budget projection. Let's continue. Material costs. 50% of material costs will be paid in the quarter they were purchased. The other 50% will be paid in the following quarter. At the end of 2016, the amount that we owe was $10,600, and that amount we expect to pay in the first quarter of 2017. Direct labor cost is paid 100% as it incurs. Manufacturing overhead, selling, admin expenses, all other items except depreciation are paid in the quarter incurred as well. Now remember, we're doing a cash budget, right? Depreciation is a non-cash expense, so we'll see how that is going to factor into producing our cash budget. Other information, management plans to purchase a truck in the second quarter for $10,000. We're making equally quality payments of the estimated annual income taxes. Loans are repaid in the earliest quarter in which there is sufficient cash, meaning that there's cash that's going to exceed the minimal required ending balance of $15,000. Prepare a schedule of collections from our customers, which means now we're ready to prepare our cash budget. So you ready? You sure? You positive? Well, guess what? We have to wait. I'm going to end this video, and prepare our last video showing our cash budget and our budgeted balance sheet.